Welcome to MES e-learning channel. Today the topic that will be explaining is types of mutual fund. Again, mutual fund is a pooling of asset. It has different varied diversification of avenues or schemes, we can say. Practically the types of mutual fund is divided into three categories, we can say. The first category is equity, the second category is debt, and the third category is hybrid. These are the main three categories that you find in every mutual fund scheme. So, understanding different types of mutual fund scheme basically can help the investors to choose a correct scheme aligned with their investment goals. So, this is where the types of mutual fund comes into the picture. As we say, types of mutual fund, there are equity funds. We start with the equity funds first. There are several bifurcation to equity funds. It can be growth funds, it can be value funds, it can be dividend funds. So, when you have funds named like Axis Bank growth funds, so it's basically equity funds. If the fund name is HDFC value funds, so it's again an equity oriented fund. And if you have dividend funds, the funds where it says that it will be giving you dividend, so that comes across as an equity funds, because a dividend is something that you get from equity funds. And what is equity funds? Equity funds is practically what it says. It invests in stock markets, equities, shares. So, equity funds have practically 65 to 70% of its investment in stock market. So, all the funds which come as a name or under the name of growth funds, value funds and dividend funds, it's called as equity funds. Equity funds are practically high risk. Every equity fund scheme that you come across will always have high risk. So, this is one of the character of equity funds, that they come with high risk, but as is the fundamental of investments, if you go for high risk, that means you expect high returns. So, this is the basic investment fundamental. So, equity funds are high risk, but equity funds are also giving you high returns value. So, when you come around growth funds is like typically invest in stocks and companies of high growth potential. So, practically let us say large cap companies which are well established, so blue chip companies. This is where you have funds which comes under the name of growth funds. So, growth funds are those who invest in growth potential, high growth potential companies, blue chips, large capital, maybe in major sectors like IT, healthcare, consumer, FMCGs, etc. So, growth funds practically invest in large capital companies. Value funds are those who come with capital appreciation. That means if you get an equity value focused on investing in those companies which are undervalued by the market. That means even though the market valuation shows undervalued, but still the company's intrinsic value is very high. So, if you know the importance of intrinsic value, you can always invest in those funds, because these companies will be of high value in the future. So, this is where the concept of value funds comes into the equity funds. So, they basically invest in companies who are low to price earning, that is PE ratio will be low, the price to book ratios will be low, but their intrinsic value will be high. They will practically undervalued companies in stock market. They will come under the category of undervalued companies in stock market. Their values may seem to be very less as compared to other companies, but their intrinsic values are very high. So, it is a good option, or it is wise investment to do in undervalued companies, because their valuation increases by the time. So, that is where it comes to capital appreciation. So, value funds gives you capital appreciation. Coming to dividend funds, equity dividend funds focuses on investment in companies that pay consistent and reliable dividend. The companies which comes under the category of paying 30% dividend, 40% dividend, 10%, 15% continuous dividend, a handsome dividend to the investor, they come under dividend funds. Like an investor who would like to receive some returns by the end of the year, they always go for dividend funds. So, dividend funds generate income for the investors, and their potential provide capital appreciation for long term. So, you get capital appreciation, at the same time you get returns also by way of dividend. Then you have fixed income funds, it is called as debt funds also. Debt funds are practically fixed income securities, we say, or fixed income funds. They are basically bonds and debentures. So, you have three types of bonds and debentures, we can say practically, like government bonds, corporate bonds and high yield bonds. Fixed income is one of the feature of debt funds. The income that you derive from debt funds is interest. The income that you get from equity fund is dividend, and the income that you get from debt funds is interest. So these government bonds can be of short term, medium term and long term. Short term can be as short as 1 year, that is money market. It can be medium term, 1 to 5 years. It can be long term from 5 to 15 years. So you have all sorts of bonds and debentures depending upon short term, medium term and long term. Investors who like to have some regular stable income, whose risk appetite is from low to moderate, these are the investors, they are the investors who look for fixed income funds. So mutual fund gives you an opportunity to invest in fixed income funds also. So you have options in fixed income, you can invest in money market mutual funds, you can invest in government bonds, you call it as gilt funds, G-Sec securities, you can also invest in corporate bonds, maybe large cap corporate bonds, small cap corporate bonds, etc. Usually they give you very high returns. The corporate bonds give you very high returns, whereas the government bonds, even though comparatively less, but they have lower risk. So wherever there is lower risk, there will be lower return. Wherever there is high returns, inevitably there will be high risk also. Then you have high yield bonds, which definitely gives you higher returns comparative to government and corporate, and it also has potentially high risk of default or loss of principal. So bonds like junk bonds, infrastructural bonds, or even for the case like electoral bonds, etc. These are the examples of high yield bonds. So you have seen what are the different types of fixed income funds, which is also called as debt funds. Coming to the next, we have hybrid, or what you call as balanced fund. It's a combination of both. If an investor wants to have the best of both, or the best of equity and the best of debt, then you have balanced fund, call it as hybrid. Asset allocation typically, diversification and risk management. These are the three characteristics of balanced fund. So balanced fund typically invest in mixed stocks, they invest in both equity and debts. So if you're taken a balanced fund, then you have to see what is the ratio of their investment. If their investment is more towards equity, then it practically becomes an equity fund. If the investment is more towards debt instruments, then it becomes a debt fund. But then it gives you a combination of both. So you have a benefit of investing in both high risk as well as low risk. So it depends upon each asset class, how they have mitigating the risk. So one way of mitigating the risk is basically making a balanced fund or investing in a balanced fund. It gives you a lot of diversification. It gives you an opportunity to invest in both equity as well as debt at the same time. And the portfolio of that investment is also varied. It starts from low risk to moderate and moderate to high. So you have all kind of variable risk mitigation factors in balanced fund. So this is another type, money market funds, that is liquid funds. So apart from the first three category like equity, debt and hybrid, you also have liquid funds, that is money market. Liquid funds practically invest only for 1 year. Within 1 year, your investment will be matured. So it's practically low risk, high liquidity. It gives you a stable income, so it gives you a stability in your NAV, and it's an income generation because practically comes under fixed income securities. So it's quite beneficial if you don't want to invest for too long in mutual funds. You would like to have some returns within a year. You don't want to go for high risk or moderate, you want to go for a low risk, or you have a low risk appetite and you want to have some kind of stability. So these money market mutual funds practically invest in treasury bills, which is issued by RBI, commercial paper, certificate of deposit. These are the instruments that money market funds invest in. So this gives you a stable income, a low to moderate risk factor, high liquidity because it's easily, there are easy buyers and sellers because of its nature of fund, because it's typically treasury bills issued by RBI, so anybody will buy it. Commercial papers, commercial certificate of deposit, so they have high ratio of buyers and sellers. So it's practically liquid and it gives you a handsome income as a interest, a good interest as per the RBI benchmark. So money market funds are also one of the categories of types of mutual fund. Then you have index fund. Now, apart from all these, where you invest in equity and debt, you are investing in indexes. Now, when you say indexes like Nifty 50, Nifty 100, S&P, BSE Sensex, these are the indexes. You have many more indexes. But when you are practically investing in companies which come under these indexes. You call them as index fund. So it's passive investment practically, because you don't have to do anything. It follows the market trend as and how the market indexes go up and down, or what is the volatility of these indexes is the volatility of your portfolio also. You don't have to be actively making plans of investment, you don't have to be observing the market every now and then, it rather matches with the performance of the underlying index. So whatever is the performance of the index, so will be the performance of your mutual fund portfolio. It gives you a lot of diversification because a lot of different categories, sector, theme, industry comes under the index. So you are investing in varieties of industry at the same time. So there's a lot of diversification under index fund. And because you have economies of scale, so the fees are also practically less or practically lower as compared to the other. And you have a market tracking because you're practically investing in index funds which is designed to track the performance of the market. So you have automatic market tracking system for your mutual fund portfolio also, because you're investing in index fund. The next category that we have is ETFs. Again, exchange traded funds provides you with diversification, flexibility, its cost efficient, it's a bit lower as compared to all the other investment, and gives you a transparency or a disclosure concept which makes investors very clear and have a clear understanding of the composition and its risk profile of the investment. So exchange traded funds gives you a lot of basket of securities, again a combination of securities in stocks, bonds, commodities in a single investment. So you have a very good well risk mitigated or risk diverse portfolio. That is something that ETFs gives you. So these are the type of mutual funds, we can say classifications of mutual fund: equity, debt, hybrid, liquid funds and ETFs. Hope you understood the topic. Thank you very much.